Hi guys, welcome to our channel. Real estate tokenization promises a seductive shortcut. Buy a token, own a slice of a house, sit back and collect rent, all without the headaches of local management, title searches, or legal paperwork. In reality, that promise is often a mirage. Tokens rarely convey legal title. They usually represent contractual claims in an SPV or trust. When the physical asset runs into problems, code violations, unpaid taxes, disputed deeds, or local court orders, token holders discover they are owners in name only, ledger entries with little practical power. Below we explain with evidence why holding a token is not the same as being a landlord, and why that distinction destroys the industry's most basic sales pitch. Tokens title, the structural reality. Most real estate tokens do not grant direct property title on the county land registry. Instead, platforms create an SPV, special purpose vehicle, or trust that actually owns the property. Tokens represent equity or contractual rights to the SPV's cash flows or profits. That legal layering is not a technicality. It's the core reason token holders often lack the ordinary enforcement tools of real property owners. For example, the ability to force a sale, foreclose, or demand repairs through local courts. Authoritative legal analyses and industry explainers make this clear. Tokenization primarily issues digital share certificates backed by SPVs, not digitized deeds that appear on public land registries. Put plainly, a token is a claim on an entity that claims to own the deed, not the deed itself. That makes your ownership dependent on the SPV's legal and operational integrity. Real-world proof. Detroit's legal shockwave theory becomes peril when the SPV's operations break down. Recent reporting and court filings in Detroit provide a live case study. Investigations by local media documented complaints about neglected repairs, alleged unpaid municipal taxes, and questions about deed paperwork tied to tokenized property operators. Detroit's Corporation Council and court stepped in. A judge issued orders restricting rent collection and evictions on hundreds of token-linked properties until compliance and repairs were demonstrated. Those measures directly interrupted on-chain distributions that token holders expected to receive. The headline here is blunt. When the local legal system freezes rent or demands remediation, the token on your wallet continues to exist. But the cash flow it was supposed to represent can be redirected, escrowed, or stopped entirely by off-chain legal action. Why token holders are practically powerless. When trouble hits the property, token holders face four linked handicaps: diffuse ownership, concentrated control. Tokens spread economic ownership across many small holders worldwide, while control, property management, tax payments, insurance, remains centralized in local managers or the SPV. Coordinating a legal response across thousands of dispersed token holders is slow, expensive, and often impossible in practice. Contractual remedies are slow or illusory. Even if token terms promise remedies, enforcing them requires litigation against the SPV or platform in a jurisdiction that may be foreign to most token holders. That is costly and uncertain. Operational failures trump on-chain rights. No smart contract can fix a leaking roof, remove code violations, or pay delinquent property taxes. Local governments can intervene and change the property's status irrespective of ledger entries, regulatory and title ambiguity. If the SPV never completed required transfer filings, or if mortgages, liens were mishandled, token holders' claims rest on shaky legal ground, sometimes contradicted by county records and municipal enforcement. Investigative reporting has found precisely this kind of mismatch. Securities law and the limits of ownership regulators have made a separate but related point. Tokenized claims that promise profits or income are often securities under existing law. The U.S. SEC's guidance emphasizes that converting an asset to a token does not change its legal nature. Tokenized securities remain securities and must meet disclosure, custody, and trading rules. That classification affects who may buy tokens, how they can be traded, and what disclosures are mandatory, all of which shape the practical rights of token holders. The implication is stark. Even if a token purports to represent an ownership share, regulators treat it like a financial instrument, not a registered deed. That legal framing shifts investor rights toward securities remedies, disclosures, rescission, broker-dealer protections, rather than straightforward property law remedies. Cross-border buying makes enforcement worse. Real estate token platforms commonly market U.S. properties to non-U.S. buyers while restricting U.S. retail purchases to avoid domestic securities hurdles. That strategy creates a perverse outcome. Foreigners buy fractional economic interests in U.S. homes but face the weakest remedy options when things go wrong. They cannot easily sue in local courts and may lack access to the regulatory protections U.S. investors would have enjoyed. This regulatory arbitrage amplifies the ownership mirage. Global buyers hold tokens, but their legal paths to recover value are fragmented and costly. Real investor harms we've already observed. From the Detroit reporting and court actions, we can extract concrete investor harms that will repeat unless structural fixes happen. Interrupted cash flows. Courts can force rents into escrow or bar collection, instantly halting token dividends. Title risk. Sales processed improperly or liens unpaid can make the SPV's ownership contestable, diminishing the asset's value. Enforcement costs. Aggregated token holders rarely have the appetite or legal standing to pursue efficient collective remedies. Liquidity collapse, market confidence craters, secondary demand disappears, and tokens trade at steep discounts or not at all. What investors must demand, minimum safeguards. If we are to accept any real estate token offering, we must insist on verifiable off-chain proofs and protections before placing capital at risk. Public deed and county record verification, not just platform claims. Require a certified title search, tax and lien history for the SPV and underlying property with receipts for recent payments. Local property management audit and escrowed repair reserves, independent trustee for older properties. Clear legal structure disclosures, SPV documents, investor rights, dispute resolution venue and remedies. Regulatory status, copies of legal opinions on securities, registration, and a clear explanation of which jurisdictions are excluded and why. Escrowed rent protocols showing how rents will be handled if municipal action occurs. Absent these items, tokens are little more than speculative IOUs backed by a set of promises that collapse when local law bites. Conclusion, call it what it is, digital claims, not landlordship. Real estate tokenization can be an important innovation, but only if it honestly reconciles digital claims with the physical legal infrastructure of property. Right now, many platforms sell the convenience of a token while outsourcing the hardest, most expensive work, securing title, paying taxes, maintaining buildings, and ensuring local compliance. The result is an ownership mirage. Digital holders believe they are landlords, but the legal, operational, and enforcement power remains elsewhere. If we care about protecting investors and tenants, the industry must stop treating tokens as a marketing veneer and start proving, with county deeds, audited management, escrow funds, and regulated trading venues, that tokens correspond to enforceable, well-governed property rights. Until then, holding a real estate token is not ownership. It is a ledger entry whose real-world value can vanish when local systems assert themselves. That is not innovation. It is a risk that should frighten every investor who believes a token automatically makes them a landlord.